Hello and good morning. I'm Ken Leon, Director of Equity Research at CFRA, and we're delighted to present to you an investor's guide to Bitcoin featuring Chris Kuiper, Vice President Equity Research. Next. So before I get a short infomercial on CFRA, let me also share that during Chris's presentation, in your console, you can go to webinar, and there's a section there where you can send in questions. We'll have ample time at the back end to cover ground and areas related to the presentation. First on CFRA. CFRA is one of the largest independent research firms in the world with over 75 professional analysts. Our focus is fundamental equity research, and our expertise ranges from sectors, industries, companies, and forensic accounting. Our flywheel, if you will, in terms of our analytics, does produce commentary that ranges from macro market commentary from Sam Stovall, our chief investment strategist, to his weekly sector watches, harmonizing with our analysts and covering 11 sectors and 68 industries. Todd Rosenbluth heads up our ETF and mutual fund research. Todd is regularly publishing on MarketScope Advisors thematic research, widely known in the media. And the base of our research is qualitative research of 1,500 global companies, and our idea generation as well. Next slide. Most important, CFRA research is independent, and our research and our resources are all dedicated to our fundamental research, whether it be sales, marketing, product development, IT, the research team. It's all for fundamental research, independent, providing those opinions and research and performance for our customers. So while other independent investment research providers claim there's no conflicts, they may have other businesses related to asset management or investment banking. Next. So with that, let me turn the program over to Chris and get right into Bitcoin. Good morning, Chris.
Good morning. Thank you, Ken, and thank you everyone for joining us today. Certainly an interesting week and another interesting day in Bitcoin as we push all-time highs again. But in this presentation, our goal is to give you kind of a non-technical investor's guide to Bitcoin. So we're going to be taking the stance not as a technologist or an economist, but someone who's looking at Bitcoin from an investment perspective. The things we want to answer today, and what we're going to try to answer, is what is Bitcoin? Why is it important? How is Bitcoin like money, and how is it different? How does it compare to gold and other currencies? Does Bitcoin make sense as an investment, or doesn't it? What are some ways we can think about valuation? And then at the end, I'm going to talk only about 35 minutes. I'm going to try to pack a lot in so we can get to your questions and questions from Ken, specifically talking a lot about the risks and some of the misconceptions we see. Just a little bit about me. I've been covering a number of companies at CFRA for a few years. Most importantly, related to Bitcoin, I cover the payment companies like Square, PayPal, Visa, and MasterCard, which are increasingly getting into Bitcoin's world. I also cover the financial exchanges like CBOE and CME. They were one of the first exchanges to launch derivatives such as futures and options on Bitcoin. And then also, before CFRA, I actually became interested in Bitcoin personally way back in 2012. I also have a master's degree in economics. I accepted a fellowship from George Mason University. I specifically said, if I'm going to get a master's in economics, I want it to be at George Mason because I had an interest in monetary theory and history. I got to study under professors such as Dr. Larry White, who's one of the foremost experts on monetary theory and free banking. So all of this is to say is that Bitcoin has just been this wonderful intersection of all of my personal and professional interests. So I'm really excited to talk to you today. First, to get a quick disclosure out of the way, I, Chris Kuiper, personally own Bitcoin. This webinar is for informational purposes only, and it's not meant as a recommendation to buy or sell Bitcoin or any other cryptocurrency. Again, we're going to talk a lot about why Bitcoin's interesting, but this shouldn't be viewed as just, only a bull case for Bitcoin. Especially during the Q&A section, we're going to talk about a lot of the risks as well, because we want to give you a very fair and balanced kind of presentation on Bitcoin here. So let's get right into it. What is Bitcoin? You may have heard a few things or may have some notions of it's a weird cryptographic thing for computer nerds. It's magic internet money. It's only used by people trying to get money out of others, extort them with ransomware or for illegal drugs. So I want to just dispel a lot of that and kind of build up what is Bitcoin from the ground up. So if you can put those aside, maybe you have some ideas, but hopefully you'll learn something new or come away with a fresh perspective here. The thing that makes Bitcoin confusing and why a lot of people have different ideas about it is because the word Bitcoin can actually refer to two different but related things. So we have Bitcoin, the network, and I'll go into each of these in more depth, but Bitcoin, the network, is simply just software code. It's a protocol. It refers to all the computers that are connected together that make up the Bitcoin network, and this network acts as a payment system. Then you also have Bitcoin, the asset. And so here's what people are talking about when they say, I bought a Bitcoin, or Bitcoin's trading at $45,000 today. These are digital tokens that are native to the network, and they're increasingly being treated as money. So same word, Bitcoin, but two different things. Some people like to distinguish them by saying the network with a capital B and the token or the asset with a lowercase b. And so we'll try to do the same here as well. So let's start with Bitcoin, the network. Bitcoin, the network, is just code running on many different computers that are connected together. To take a step back, before it was that, it was just an idea. It was a white paper. Here you can see a snapshot of the actual Bitcoin white paper published on October 31, 2008. And I encourage you to go and Google this and just read the first page. It's actually very accessible, very readable. And you see that the person or persons who wrote this said, hey, there's this problem with the internet. We can transact digitally all kinds of things. We can send each other files and photos and games and music, but we can't send each other money without bringing on another third party. Someone has to come in and verify money. So we don't have a truly electronic version of cash yet. If Ken and I are sitting at the same table in the real world, I can hand him $1 and that transaction is done. If I want to send Ken $1 over the internet, well, now I got to involve a third person. I've got to involve PayPal or Venmo or Visa or MasterCard or my bank or someone. So that's the problem Bitcoin set out to solve. This idea was put into practice. It was built with software code. That code is now operated on millions of machines that are all connected, much like the internet. These machines running the code make up a decentralized network. And then because it's decentralized, nobody owns the network. The code is like a protocol that governs how the network operates. So you may have heard of HTTP as a protocol. It's a protocol that governs how web pages operate on the internet. Nobody owns that protocol. It's not patented, but everybody uses it and everybody can see how it works, and it governs how web pages work. Well, Bitcoin governs how payments work on the Bitcoin network. So why is this important and potentially revolutionary? Bitcoin is the first ever completely decentralized peer-to-peer payment network. That's a lot in one sentence. So we're going to break it down by just looking at how Bitcoin is different from our current payment system. So in a traditional payment system, if I want to send money to Ken, I'm going to call up my bank or go online and tell my bank to send $20 to Ken. And how that's going to be done, and to make this example easy, let's say we both bank at the same bank, just for simplicity purposes. The bank isn't going to go to their vaults and take $20 out of a box that has my name on it and bring it over to a box that has Ken's name on it. Now, obviously, they just have a big ledger. They're going to debit my account and they're going to credit Ken's account. And they're going to do this electronically. It's just an electronic ledger. So the key here is you have a centralized ledger maintained by this third party, this intermediary, the bank. Now, this can be very efficient if everyone trusts the intermediary, but it also has a lot of downsides. It can be expensive. Fraud is unavoidable and costly. This is why banks are the ones that try to keep out bad actors. You have to fill out a lot of information about yourself and give up a lot of information to the bank because they're trying to avoid that fraud. It's a closed system. If you don't have an account at a traditional banking system, you're locked out. We hear a lot about the unbanked and the underbanked, especially in emerging or developing economies. Also, your transactions accounts can be frozen or seized, either by the bank itself or by an outside actor like a government. So we're familiar with our traditional payment system. So what about the Bitcoin payment network? This is a simplified drawing, but again, if I want to send $20 to Ken, instead of having a centralized ledger maintained by one person, you have all the computers on the Bitcoin network maintaining the same ledger. They all have the exact same copy of the same ledger. So when I want to send money to Ken, I broadcast out to the network and say, please take $20 out of my account and send it to Ken's. And so the network can see my account on the ledger that they're all looking at, and they'll debit it, and then they'll credit Ken's account. And then they all update the same ledger, and so everyone can see that I sent $20 to Ken. So it's transparent, and anyone can view it. So if I try to send another $20 to Ken and I don't have that money in the account, all of these computers are going to say, no, you're not allowed to do that. We're going to block the transaction because we can see you don't have that money in your account. Again, simplified kind of overview, but hopefully you get the idea that this is a distributed ledger maintained by the whole network. So it's like a giant spreadsheet that's transparent. The key here is there's no need to trust a single intermediary. There's not one person or bank that can say yes or no. It's verified by all these computers together. This network is open. It operates 24 hours a day, 7 days a week, 365 days a year. Anybody can join it. Transactions are verifiable, they're secure, and they're irreversible. So the key here is anyone can send any amount of money to anyone else, anywhere in the world, at any time. This has never been possible before, and this is what gets people excited. I think we in our Western world, our developed economies, sometimes say, what's the big deal? PayPal and Venmo and Visa and MasterCard, they all work great. They're, for my purposes, pretty much instantaneous. But talk to people who are experiencing, inflation or capital controls, or they don't have access to banks in emerging or developing economies, and you start to see why this is such a big deal. You can even today, if I try to send money to someone halfway around the world internationally, it can take 3, 4, 5 days or more. I mean, I could almost get on a plane and deliver the cash in person faster than that. But the Bitcoin network can do this almost instantaneously, 10 minutes, maybe a couple hours, any point in time, anywhere in the world to anyone. All you need is a computer or a very simple cell phone, internet connection, even just a radio signal sometimes. All right, so that's Bitcoin, the network, but we're gonna focus now on Bitcoin, the asset, the token. So the network produces a native digital token. This is also called Bitcoin, as we've said, which makes it a bit confusing. These digital tokens are not as odd as they sound. So you might be thinking, why would I give value to a digital token that's just made up? However, I'd like to point out, we already use digital tokens for things like video games. If you play games or know younger persons who play games, you know that they will routinely trade in their hard US earned dollars for digital tokens that they can use in a video game just for fun. And those tokens have value. People trade them and buy them and sell them. Maybe a better example is credit card points. The credit card company issues you points. Those are just basically digital tokens. And you ascribe value to them because you can redeem them, you can spend them, you can use them, you can transfer them. Also note that our currency is already digital. So this isn't that big of a leap either. Very few of our transactions, especially larger transactions, are done with physical paper or coins. It's all ones and zeros on a ledger somewhere, someplace. So users are ascribing value to the Bitcoin tokens, and they're increasingly treating them like money. So how is Bitcoin money, if we're treating it like money? How is it similar to our current money, and how is it different? Well, similarities are pretty easy. With Bitcoin tokens, you can send them, you can receive them, you can buy things with them, you can convert them to other currencies, and Bitcoin fluctuates in price compared to other currencies. So just like foreign exchange markets where the dollar goes up or down versus the yen or the euro, Bitcoin goes up or down versus the US dollar or yen or euro as well. Big differences though. Bitcoin is not owned, controlled, regulated, or backed by any government, central bank, other institution, or company. So in other words, there's no single person or institution that can control Bitcoin. The other very big difference is Bitcoin's monetary policy. So Bitcoin has a hard cap. There will only ever be 21 million Bitcoin in existence. And we know this because we can verify the code, and I'll take you through this, but we can easily see what's programmed into the code. And as long as the Bitcoin network is running and the code isn't changed by a majority of people using it, there will only ever be 21 million Bitcoin. And to put this in perspective, there's, I think, around 50 million millionaires in the world. So if every millionaire in the world wanted just one whole Bitcoin, there wouldn't be enough. So let's go deeper into Bitcoin's monetary policy. Bitcoin has a pre-programmed inflation schedule. So new Bitcoin are created or minted approximately every 10 minutes. Every 10 minutes, new Bitcoin get released into the network. So this started at 50 Bitcoin every 10 minutes. But that schedule is cut in half every 4 years. Again, this is all stipulated in the code. So it started at 50, it got cut to 25 4 years later. 4 years later, it got cut to 12.5. And then this past May in 2020, it got cut in half again to 6.25. So currently only 6.25 Bitcoin are created every 10 minutes, or about 900 per month. So if you look at a graph of this inflation schedule, you can see the number of Bitcoin increases rapidly, and it's still growing, but that rate of growth is slowing down. And so at the end of 2020, there were 18.6 million Bitcoin in existence, or almost 89% of the total supply. By the end of this year, 2021, 90% of that total 21 million will be already released. The final Bitcoin, because this is kind of an exponential function of half every 4 years, the final Bitcoin actually won't be created until the year 2140, long after we're dead. So if we think of Bitcoin as money, the question eventually becomes, if you study Bitcoin enough, well, what exactly is money? And without going too deep down this rabbit hole, let me just say that, over history, we've observed many things be money. We've seen shells, beads, furs, stones, all kinds of things have been treated as money. But inevitably, what historians and economists have found is that good money has a number of desirable properties that make it useful money. So for example, good money is durable. And by durable, we mean it doesn't rust, rot, decay, but it also maintains its purchasing power. So on this, we give Bitcoin a plus because Bitcoin's virtual. It's not going to rot like grain or rust. And then it should maintain its purchasing power because it has a finite supply. Divisible just means you can divide it up for small transactions. This is actually a common myth when people hear about Bitcoin. They say, I can't buy Bitcoin because it's trading at $45,000 today. That's way too expensive. Bitcoin can be divided to 8 decimal places. So you can buy a fraction of a fraction of a fraction of a Bitcoin. You could buy $1 worth, $10 worth, $100 worth, whatever amount you want. Fungible just means you can exchange it. They're all the same. It's homogeneous. One Bitcoin is one Bitcoin. For example, diamonds would not be fungible because you've got different cut, clarity, and sizes of diamonds. Portable, does it have a high value to weight ratio? Can you move a lot of Bitcoin around? Yes, you can move $10 around the world, or you can move $10 billion around the world. It doesn't matter to the network. It doesn't care, and it costs you the exact same flat fee, which is incredible. Verifiable, the Bitcoin network is always verifying Bitcoin to make sure it's genuine, it's not fraudulent. History, here we're talking about track record. And this is where Bitcoin fails because it's only been around 12 years. So a big minus or a big X there. And then is it scarce? Yes, as we talked about, there'll only ever be 21 million Bitcoin. Gold, on the other hand, fulfills a lot of these properties. It's physical gold's not very divisible, though. You can't shave off flakes of gold to buy a cup of coffee. Larger amounts of gold are not very portable. Again, thinking about moving $10 billion around the world is just as easy with Bitcoin as $10. But with gold, if you wanted to move $10 billion of gold halfway around the world, you're talking about incredible logistics, insurance, hiring armed guards, all kinds of things. Gold is verifiable, but you'd have to, melt it down or hammer it out to make sure there's no tungsten in your gold bar, for example. Gold, of course, is much better in terms of track record than Bitcoin because it's literally been around for millennia. And then gold is also scarce, something we'll talk about later as well. Fiat currencies, on the other hand, are a mixed bag. And by fiat, I mean our current monetary system of paper money that cannot be redeemed for anything else. It's not backed by anything. Fiat, coming from the Latin word to decree, our money today is just money because the government decrees it. The government says so. It's law. We give an X for durable because, as we'll see, fiat money is very bad at maintaining purchasing power. It is divisible, especially electronic fiat money. Fungible, yeah, a US dollar is a US dollar, but as soon as I want to take it over the border, I can't exchange one US dollar for one Canadian dollar 1-to-1, or a yen or a euro. Fiat money is portable, especially digital money, but if you want to move a lot of paper fiat money around, it gets a little harder. It is verifiable, but it can be counterfeited. And then history, we've only had our current fiat system for about 40 years since Nixon took us off the gold standard. That's the only time when the entire world has been on a complete fiat system with nothing backing it at all. All other time throughout history, either one country or some countries have had some kind of peg to gold or something else. And then scarce, there's nothing physically preventing fiat currency from being produced, only the willpower of the government or the central bank that is issuing it. So a quick review, remember Bitcoin can refer to two different things, either the network or the asset. But if I had to sum this up in one sentence for you, I'm gonna take a page out of Saifedean Ammouz's book, The Bitcoin Standard, which I'd highly recommend, because I think he does a really good job packaging this into one sentence. What is Bitcoin? Bitcoin can be best understood as distributed software that allows for transfer of value using a currency protected from unexpected inflation without relying on trusted third parties. Now, if you're completely new to Bitcoin, you're probably thinking, I have no idea what you're talking about. This sounds ridiculous. And that's fine. I was there for many years. It took many years to wrap my head around what Bitcoin is or what it could be or what it might be. It's all very confusing. And again, if you think about like the early days of the internet, there were people saying the internet's going to change the world. It's going to do all these things. And other people said, I don't know what you're talking about. The famous quote from Paul Krugman is, the internet is going to have no more impact than the fax machine. So some people, look at Bitcoin, they say, I don't see it. Other people see this as an amazing thing. It takes a while to understand it, and of course we don't know what will happen, but all I'm trying to say is don't feel bad if you feel a little confused. And I'll end this section about what Bitcoin is with a question. What does the platypus and Bitcoin have in common? This was something I read a few years ago by Spencer Bogart, and I think it's just a wonderful illustration. Before I answer that question, I'll tell a little story, and I think you'll see where this is going. When the first naturalists from Europe found the platypus in Australia, they were very perplexed by this creature, and they sent a description and a drawing back to Europe, trying to describe it. And the people back in Europe thought for sure this was a joke. It was a hoax. Because if you look at the picture, the platypus has a bill like a duck. It looks like a mammal with its fur, yet the female lays eggs. It's got kind of like an otter tail and beaver feet, and the male platypus actually has a spur on its back leg, or I guess both male and females have a spur, but the male can actually produce venom out of that spur. So the question was, well, first of all, is this a hoax? They actually asked for a specimen, and the naturalists sent over a pelt, and the Europeans still didn't believe it. They looked at the pelt and they said, this is obviously some work of a skilled taxidermist who has sewn together all kinds of parts of different animals. So the question, and even decades after they realized this really was a true animal, they said, well, what is it? Do we classify it as a beaver, a duck, a mammal, a reptile, an otter? And the answer is it's all of these and none of these, right? It was a category creator. The platypus is the only living representative in its family and its genus. And so similarly, is Bitcoin, you look at it and you say, is it a platform? Is it a payment network? Is it digital gold? Is it a commodity? Is it a currency? Well, it could be all of these things or a few of these things. Again, both of these things are category creators. So my point is just to keep an open mind about that, and also just to demonstrate why Bitcoin is so confusing to so many people. But we're going to try to scale this down and focus on Bitcoin as an investment. So just looking more at Bitcoin, the token, and what that could mean for investors. So people look at Bitcoin as a token and say, well, this could actually be a good inflation hedge or a store of value. We talked about fiat currencies and their purchasing power. Here you can see the relative purchasing power of the US dollar since 1913, when the Federal Reserve was created. If you had $100 back in 1913, in terms of purchasing power, that would only be worth about $2 or $3 today. Also, relative purchasing power since 1971, since we went off the gold standard, $100 in 1971 would only be worth about $15 or so today. And this is not necessarily a normative statement. I'm not saying, is this good or bad? I'm just stating the fact that if you want to store some of your wealth, some of your work and energy in an asset, the US dollar is not going to do it. It will erode in value year after year. And especially since 1971, this has just been a one-way street. So if you compare Bitcoin to the US money supply, here you can see the amount of dollars created. Not only has that constantly been going up, but most recently with the coronavirus pandemic, we've got that sharp move to the right there. So in the table, you can see the annual inflation rate of Bitcoin currently is about 1.8%. That's going to get cut in half again in only 3 years. The US dollar creation rate, M1, is about 70% year over year right now. Now, I know M1 isn't necessarily money that's all going out into the broad consumer public, and so it doesn't necessarily have to push up the CPI. But even so, 1.8% inflation rate for Bitcoin is still lower than the US average inflation rate, and it's much lower than the global inflation rate in 2020. So you start to see why Bitcoin becomes desirable as an inflation hedge. Here, I'm just going to show you the two charts, the US money supply versus Bitcoin's money supply, because I think it's just really interesting to see how these are almost mirror images of each other. If you drew a 45-degree line, it's almost like they're reflective of each other. And again, just emphasizing why people are beginning to look at Bitcoin as an inflation hedge or store of value. The other big thing investors are getting excited about is looking at Bitcoin as an alternative investment. So alternative investment just, is kind of a catch-all for anything that's not a typical stock or bond. And the two big qualities that you want to see in an alternative investment is diversification and asymmetric returns. Remember, diversification is called the only free lunch in finance. Can you lower your risk without sacrificing returns? And if you look at the daily return correlations of Bitcoin versus major asset classes, Bitcoin is not very correlated at all. So you would pick up a lot of diversification here. It's not correlated to stocks, US stocks, international stocks, treasuries, corporate bonds, real estate, gold, or commodities. If you look at monthly return correlations, they move up just a little bit, but still very not correlated at all. What about asymmetric returns? Is there a lot of upside with not a lot of downside? And obviously Bitcoin is still very young, but if we look at just the last 6 years, let's say you start with a traditional 60-40 portfolio, 60% stocks, 40% bonds, you'd have a compound annual growth rate of about 9%. Standard deviation, which is usually a measure of risk, 9%. You'd experience a max drawdown of about 12% and a Sharpe ratio of 0.87. Sharpe ratio, if you're unfamiliar, it's just a measure of how much extra risk above market risk are you getting per unit of, or how much extra return, are you getting per unit of market risk. If you take away 0.5% of stocks and 0.5% of bonds and you put that into Bitcoin, so you've got 1% Bitcoin, your compound annual growth rate goes up. Your standard deviation or your risk goes up a little bit, but as you can see with the Sharpe ratio, that's more than compensated for that extra return. Now, a traditional portfolio, you've moved to 5% Bitcoin, your compound annual growth rate more than doubles. You do take on a little more risk, but again, that extra reward is worth it. Your Sharpe ratio goes much higher and you're much less correlated to the US stock market. And let me point out, this is assuming annual rebalancing to target weights. So it's not just putting 5% into Bitcoin and letting it run and take over 60% of your portfolio, it's trimming that back every year to that 5% or that 1%. Okay, so how to value Bitcoin? Bitcoin, of course, is tricky to value from a traditional finance perspective because there's no cash flows, there's no dividends, so we can't discount those back to today. And if you're going to be investing in something, you need to have some idea of what its value is, right? So first, the question is, well, do you value Bitcoin as a network, a payment network, or do you value Bitcoin, the token itself? As Bitcoin has evolved, so has the narrative of what it is. So here's an interesting chart from Nick Carter. It only goes through 2018, but they analyze what people were talking about in forums and articles in terms of Bitcoin. And they found early on, people were talking about Bitcoin as like an e-cash or a proof of concept. That cheap payments networks, that's the red bar, that got bigger and bigger. The payment network narrative peaked around 2011 to 2015. Excuse me. And then, as you can see, that got a lot smaller. And what has emerged as the narrative of Bitcoin as a reserve currency, as censorship-resistant e-gold, or gold 2.0, and then also just an uncorrelated financial asset. That's that pink part at the top. And I think that's what you're really seeing today. Bitcoin viewed as gold, or Bitcoin viewed as this uncorrelated financial asset, a new alternative asset, just like we talked about. And so I think it makes sense to start to value Bitcoin, the token, not Bitcoin, the network. So just remember, if when we looked at this chart here, Bitcoin actually improved or actually had the same properties of gold and even improved upon some of gold's deficiencies. So if we're thinking about valuing Bitcoin, it makes sense to say, okay, if Bitcoin is gold 2.0, a superior version of gold, what could be some possible scenarios of Bitcoin starting to take away gold's market cap or starting to cannibalize gold's market cap? So a simple way to look at that is if gold's trading at $1,850 an ounce today, there's about $12 trillion worth of gold out there. So if Bitcoin became just 5% of that, that would imply a Bitcoin price of $35,000. If Bitcoin became 7%, that'd be about $45,000, or about where we are today. If it rose to 10% of gold's market cap, that would imply a Bitcoin price of $64,000, and 15% would be $95,000. So again, this is no guarantee, but I think it just helps to frame the scale of where this could go. And also this assumes that gold continues to trade at a steady price of $1,850. If the price of gold goes up, the price of Bitcoin could also go up without it taking another or a higher percent. Another way to look at Bitcoin's value or how to value it is what's known as the stock to flow model. So stock to flow is just a measure of a commodity's ability to act as a store of value. Quite simply, you want to ask, what makes some commodities a better store of value than others? And the answer can be found in the stock to flow ratio. So this is just simply the stock, the total available out there, divided by the flow, or how much is added to the stock every year. Higher stock to flow commodities are therefore generally more valuable. And you can see in the data here, we've got gold. There's only almost 200,000 tons of gold out there, but only less than 3,000 added to that stock every year. That gives gold a stock to flow ratio of 72. Its annual supply growth is only 1.4% a year. And so it's got that market cap of what we talked about, $11 to $12 trillion. Silver also has a pretty high market cap, but its stock to flow is much lower. And then platinum might be surprising because, you know, platinum is around $1,000 an ounce, but it has a very, very low stock to flow ratio. And the reason is a lot of platinum is mined, but a lot of platinum is used up in the same period. So you're never getting ahead of that, and which is why platinum actually has a very low market value. Bitcoin, on the other hand, actually has a pretty high stock to flow ratio, but its market value is not that high yet. And you can see that in this chart here. There's gold stock to flow ratio over 70. It's got a very high market cap. Bitcoin stock to flow ratio is approaching gold, and it will hit gold's or go higher once that halving cycle happens again in 3 years. But the dot is much lower. It doesn't have the market value yet. So there's actually some analysts who have modeled this, and they've looked at Bitcoin stock to flow ratio on one axis versus price on the other axis, and they found a linear relationship between Bitcoin as well as these other assets. And so the model suggests that the dominant factor in driving Bitcoin's price is its scarcity. They found an R squared of 95%. In other words, 95% of Bitcoin's price can be explained by its change in its stock to flow ratio, or it can be explained by its scarcity. Now, of course, this model isn't perfect because, weaknesses is this is all just historical data. It's not necessarily indicative of future performance. It only considers supply, not demand. And it's just showing correlation, but not necessarily causation, as we all know. So I think it's a really interesting model to look at. Just Google stock to flow. You can find live price models of this. And it'll be very interesting to see through this next cycle if it follows this model. So if you're an investor, you're probably thinking this is all great, but why now? And a few things we'll just go over here. So first of all, if you look at Bitcoin through a technological adoption lens, you've maybe seen this Everett Rogers graph of how technology diffuses and becomes saturated into a marketplace. Surveys have found maybe 9 to 12, maybe as high as 14% of people own any cryptocurrency at all. So we're still clearly in that early adopter phase. If you use Bitcoin's own network data, remember that decentralized ledger that's transparent to everyone, if you look at that, some analysts have approximated there's 135 million Bitcoin users out there. That's only about the number of internet users in 1997. At the current adoption rate, they expect that to grow to about 1 billion Bitcoin users by 2025. Now, 1 billion's a lot, but that's actually only the number of internet users in 2005. So again, still very early in terms of adoption. The other thing that's interesting in terms of why now is the institutional adoption we're seeing. So the past cycle in 2017, when Bitcoin ran up to $19,000, was very much driven by retail traders. This cycle appears to be more institutional investors piling in. So just over the past few months, we've witnessed MicroStrategy, multi-billion-dollar publicly traded company here in Virginia. They moved all their excess cash reserves from treasuries into Bitcoin, $500 million. They subsequently issued another $650 million convertible bond and put that into Bitcoin. You can go online. Michael Saylor, the CEO, is very open about this. He recently, just last week, held an event for thousands of CEOs outlining his playbook on how to do this for their company and why. And quite frankly, he's looking at Bitcoin as that store of value narrative. He's saying we were sitting on $500 million in cash, which we could not deploy right today, but we wanted to keep it. And if we just continued to buy treasuries, we were sitting on a melting ice cube. So that's his viewpoint there. And what I think you're seeing some institutional investors come around to. Square also purchased $50 million of Bitcoin to hold on its corporate balance sheet. We're seeing insurance companies, which I think is really interesting. They're starting to dip their toes in. And then just an overall increasing number of institutional accounts are holding Bitcoin. Also, why now? You've got a very interesting macro backdrop this time around. If you're a money manager or an investor, these top 3 points above the dotted line are all making it very hard for you. Money management is a relative game. So you're looking at your options and you're saying equity markets are trading at record valuations. Bond yields are at record lows, continue to go lower. We've got $18 trillion of negative yielding bonds. And remember that classic 60-40 portfolio. If you've got 40% of your portfolio in bonds and the yield is just getting driven lower and lower and lower, how are you ever going to make up that 5, 6, 7, 8% target in order to retire or to maintain, insurance assets? So that's the situation they're in, and you start to see why Bitcoin is becoming very attractive. The other 3 points here are more macroeconomic related. We've got a U.S. federal budget deficit at record levels, not seen since World War II. You can see on the right there, the federal deficit as a percent of GDP. That's going to go a lot lower with another new $1.9 trillion stimulus package on the horizon. And you're starting to see some rising inflation expectations in the markets as well. So that was a lot. I'm going to stop there so we can start to get to questions. I'm going to hand it back over to Ken, who's been collecting questions and will moderate this session now.
Great, Chris, and this was a fabulous, interesting presentation on a nascent industry, if you will. Some basic questions, then we'll get into the more difficult ones, and then questions about what can go wrong and regulation. But first, how can I purchase a Bitcoin?
Yeah, great question. How do you purchase it? How do you get exposure to it? Without getting too technical, the way to directly hold a Bitcoin is to create a digital wallet, and then the wallet creates a public key and a private key. The public key is kind of like an email address. People can send you Bitcoin through your public key, and then the private key you keep, and that's what gives you access to that Bitcoin. So you can buy Bitcoin directly from other people, like Ken, you could buy some from me. However, the easier way, or the way most people do it, is they just buy it from an exchange. And this is just like opening an online discount brokerage exchange, like with Schwab or Fidelity or someone like that, except there's crypto-only exchanges. Now, we don't recommend any, we don't have any affiliation with them, but if you look around, you'll see like Coinbase is probably the biggest one. They're looking to IPO soon. You just open an account with them, and just like opening an online brokerage account, and then you can buy Bitcoin that way. You can get exposure through ETF-like products. There is not a true ETF yet. The SEC has not authorized a real ETF. I think it's only a matter of time, a matter of when, not if, as the infrastructure grows. But there is an ETF-like product such as the Grayscale Bitcoin Trust, ticker GBTC. It operates a little bit like a closed-end trust, so you are paying a premium above the net asset value. That premium today, I think, is around 10%, but it's gone as high as 30 or 40% when demand is really high. And then there's a 2% management fee baked in there. So again, no affiliation, not making any recommendations, just telling you what's out there and the current options.
Great. So question came in here related to Bitcoin supply. Point of control here, there's 21 million set. Is that an arbitrary cap, or could it be raised? And ultimately, does that have impact, as it relates to the value of Bitcoin?
Yeah, so the 21 million, it's just kind of how the math works out, in that if you start at 50 and you cut it in half, but you're not gonna cut it in half indefinitely. You're gonna limit Bitcoin to 8 decimal places. That's how you add those all up. That's how you get to 21 million. So, per Bitcoin, you can divide it into 100 million smaller pieces. That's the smallest unit of account. It's called the Satoshi. But just the way the inflation program has been scheduled, starting at 50, going out to dividing at 8 decimal places, you add those all up, you get to 21 million. There's nothing magical about 21 million. They could have coded Bitcoin to be 1 million or 100 million. The point is, it is capped. Now, the question about whether they could raise it is a good one, because obviously, if you're making an investment based on this assumption, you want to know that that rule is not going to get changed on you. To change the core Bitcoin code, you have to have a majority of the people on the network, particularly the people contributing the large amount of computing power required to run the network. They have to all vote in favor of it, or at least the majority have to vote in favor of it. So the people who are contributing billions of dollars of computing power and electricity to it, I don't think they're going to vote to dilute themselves and raise that cap, if that makes sense. So this is why Bitcoin is so interesting, because the incentives built into it are so aligned together. And so without getting too technical and getting into mining and all this stuff, that's just how I would kind of summarize it. It's like the people who have the most at stake are not going to vote to change the code or lift that cap, because it would be detrimental to them.
So exponentially, as supply does increase, question came in, who gets the newly coin created?
Okay, so we'll have to get a little technical here, but there's participants in the network called miners. And what miners do is they are helping maintain the integrity of the network, and they're processing transactions. So if I send you, Ken, a Bitcoin, that transaction is going to get sent out. It's going to get bundled up with other transactions, and then the miners are going to process that transaction. Now, in the Bitcoin code, the miners also have to expend a lot of electricity and computing power to do this, somewhat arbitrarily. But what that does is it maintains the integrity of the network. If anyone could just jump in with a low-powered computer and change things, there would be no security there. So again, without getting too technical, you might wonder why is a decentralized ledger secure? And the reason is there's a voting mechanism going on in the background. There's a consensus, right? The network has to come to a consensus saying, this ledger is the real one. This is the genuine one. Well, how do they come to consensus? They vote. Well, it's not one vote per computer or person or IP address. It's one vote per unit of computing power. So the people that are contributing more computing power have more voting rights. And again, this gets back to incentives. The ones who have more voting rights are contributing the most energy and time. So they have the most at stake. So they're incentivized to keep the network secure, to keep the authentic ledger real and authentic and verified. So for that, whoever invented Bitcoin foresaw this. They said, why would they do this? Well, for that work, they're the ones that get awarded the new Bitcoin. And so that's their incentive to do that. And
Right.
so the miners get the newly created Bitcoin, and then they can either sell that Bitcoin or try to keep it. A lot of them have to sell some of it to pay for their electricity costs and that sort of thing. But again, bottom line is you have these miners, they secure the network, and for that and for their effort, they're the ones that get the new Bitcoin.
Chris, I wonder if you can expand further. There was a great chart there showing how the view or perception of what Bitcoin is has changed. And one that is still significant is the reserve currency for crypto. So first explain to me, what is crypto? Is it, multiple variants out there? And then of course the application of a reserve currency on something like that.
Yeah, so that one's interesting. Yeah, you have thousands of other cryptos out there, but Bitcoin is still by far the largest. We're at $800 billion market cap or so. Bitcoin's market cap is 60% of the entire cryptocurrency market cap. So all other cryptocurrencies combined are only 40%, and Bitcoin is 60%. And so really, I think what you're seeing evolve is Bitcoin could become this base layer. And if you think of monetary systems, historically, the base layer for all monies was gold. Remember, after World War II, we had the Bretton Woods Agreement. All the countries agreed that they could have their own currencies, but they would tie or peg their currency to the US dollar, and the US dollar would peg their currency to gold. So in that situation, gold became the reserve currency. Gold was underpinning all these other currencies, the US dollar, the Swiss franc, or any other currency. So similarly, you could see other cryptocurrencies evolve, but because of Bitcoin's stable inflation and because it's the longest running code and it's never been hacked and all these other reasons, Bitcoin could become that reserve currency, that base layer. And then you start to build other currencies on top of it. But at the end of the day, they all get their value or tie it back to Bitcoin.
Chris, another question, and it resonated with the example of Bitcoin. It's not entirely new. You give the illustration of video games. And where I'm going with this is just this past week, one of the leading video game makers had cybersecurity. Their entire code on products was stolen. And the question is here, with something that is digital, it's controlled by enormous computing power. Is there a Jurassic Park weakness here? Is there an Achilles heel in terms of what can go wrong, because everything seems to be so well vetted in terms of the structure and how it works?
Yeah, as much as I marvel at Bitcoin's code and ingenious ability to align all these incentives, I can't be arrogant enough to say nothing will ever happen to it, right? I mean, that's just nature. I mean, who knows? I can say it's been around 12 years. The code is open source. Anyone can see it and view it. Obviously, there's a huge incentive to try to compromise it, billions and billions of dollars worth. So people have an incentive to compromise it, and they haven't been able to do it. There's never been a double spend on the Bitcoin network where, a Bitcoin was spent twice. There's never been any kind of breach like that. So it hasn't happened yet. Everything's open, so people should be able to see it. But yeah, at the end of the day, I'm not going to tell you guaranteed nothing can ever happen, because who knows? Who knows? There could be something nobody ever saw coming.
Great. Let me give you some basic questions again, and everyone, please keep on sending your questions. When you buy Bitcoin, are you buying the asset or are you buying the network?
Yeah, when you buy a Bitcoin token, you're buying the asset. You're buying the token, and what you're actually doing is you're getting a key that gives you access to a Bitcoin, right, to your address. If you're holding it directly yourself, not through an exchange or something like that. And that's why I think that narrative has changed to Bitcoin as an asset. If Bitcoin is just a network, if it just operates as a means of exchange, I don't think the tokens will have as much value, because you're only going to need to buy the tokens to access the network, and then you're going to convert back out of it. So if I want to send someone money around the world, and there's actually a startup doing this today, they're going to make money sending money around the world as easy as sending an email, and they're going to use Bitcoin network in the background. But people don't care about the tokens. They're saying, I want to send US dollars to Mexico, and that person gets pesos. And if in the background it uses the Bitcoin network and it converts it to Bitcoin for a split second, that's great, but it's not going to drive the value of the token, right? It's just going to only drive it insofar as people need access to the payment network, but they're not holding it as a store of value, if that makes sense.
Yes, great. So before I get to regulation questions, I want to go back to variance and crypto, and these are related questions. Will other cryptocurrencies dilute the relative value of Bitcoin? What would stop other currencies, I'm assuming here digital or crypto, from crowding this space? And is there a first mover advantage? These are all related, but really good questions.
Yeah, excellent question. They're kind of two related questions. One in there is the classic, well, Bitcoin's not really supply capped, it's not really limited or scarce because there's an unlimited number of crypto coins you can make. I can make a Chris coin, Ken could make a Ken coin, so there's no limitation here. That's true in a sense, but let's go back to why Bitcoin has such a huge position over these other ones already, and has already through its whole history. Number one, it's first mover advantage. It has the brand name. And the other massive one is network effects. It has network effects beyond what we've seen with anything else. If I tried to make a Wikipedia, for example, Wikipedia's source is open code. I could just copy Wikipedia's code and make my own Chris's Wikipedia, but nobody would go to it because of network effects, right? All the data and everyone is already on Wikipedia. Some people like to say Bitcoin could be the MySpace, the first social network, and then Facebook comes along with a better product and supplants it. That's possible. But the difference between MySpace and Facebook was you could have an account at MySpace and you could have an account at Facebook. You could hedge your bets. You could have an account at both. And then eventually everyone moved to Facebook. You can't do that with Bitcoin. You can't hold both Bitcoin and whatever other coin. $1 in Bitcoin is $1 in Bitcoin. If you want to move to another one, you've got to sell that Bitcoin and move to another one. So there's huge switching costs for people. There's tons of network effects. There's lots of miners and infrastructures already in place. So that's what I think the proponents of Bitcoin would say to that. But it's possible. I mean, I can envision a scenario where somebody does somehow invent something better that has such a huge value proposition, and it's so much better that everyone gives up and loses all of that time and infrastructure and money they've already put in Bitcoin and move to another one.
So we illustrated, Mass Mutual, institutions getting into this. Elon Musk, his company Tesla, 1.5 billion in Bitcoin, 17% or so of the company's total cash and cash equivalents. Regulation. So the question is, when will we see it? What will it be like? Or will there be hearings in Congress? Or does it require a Jurassic Park experience. But what given, and we didn't vet this, is it a security or a currency? And then lo and behold, we got the SEC and we have the CFTC. So how do we get into this discussion, Chris, in terms of Bitcoin for regulation?
Yeah, again, like the platypus, what is it? The regulators have been asking the same thing of Bitcoin. What is this? It doesn't fit any of our paradigms here. CFTC was the first to come out years ago, and they said it's a commodity. It's a digital commodity. That allowed the trading of Bitcoin futures and options. The SEC said it's not a security. And the IRS says it's property, so it's not currency. So you have to treat it like a sale of stock, like Apple stock. If you sell it, you have to report your cost basis and report either a long-term capital gain or loss. As an aside, this is also what makes Bitcoin difficult as a pure medium of exchange, because technically, every time you buy a cup of coffee, you'd have to figure out your cost basis and report that gain or loss. They haven't really set a de minimis yet on this. But in terms of coming regulation, one of the risks is that this gets heavily regulated or banned, as some companies try to do. Now, you can't physically ban it, just like the internet. You can't shut down the internet because it's decentralized. You cannot shut down the Bitcoin network because there's millions of computers running it all over the world in remote places where people don't even know. They can't trace them or track them. But if you said you can't buy it or sell it, if you're somehow caught with it, regulation could definitely put pressure on it. I do think you probably see more regulation coming down, especially as institutions get involved. The question of whether or not that's a good thing or a bad thing maybe depends. I think if it's going to be a more mainstream asset class that finds itself in a portfolio allocation among all investors, just like a 60-40 portfolio, then yeah, it's probably going to have to undergo a lot of regulation, and maybe from that standpoint, it's welcome. But yeah, I would, as it grows bigger, I would expect more regulation. That might actually be something that causes it to fall back a few years in terms of price appreciation as that gets digested. But it could be what's necessary to move it onto a mainstream store of value.
Okay, that's great. So let's look at perhaps three major actors for regulation. And no one knows for sure, but to get your take, Chris, let's go through three of them: the US, China, and the European Union, the EU. So in the US, Gary Gensler, former chair of the CFTC, now chair of the SEC, and he's been at MIT and he's been studying, and perhaps there's a white paper on his thinking about digital currencies or Bitcoin. Gary Gensler and the SEC.
Yeah, it's really interesting when his name was announced. Many people who are pro Bitcoin and cryptocurrency said this is great because look, you can even go onto his MIT course for free, and he's got a whole course that he teaches on cryptocurrencies. So the guy knows his stuff and is obviously a fan of it. So I think that bodes well for cryptocurrencies, especially an ETF in the more near future. You also have at the SEC the other chairwoman, Hester Peirce. She has been very pro Bitcoin from the start. The community nicknames her Crypto Mom. And so I think you've got a lot of positive momentum moving there. China and Europe, quite honestly, I haven't followed them as closely. China's done a number of bans and regulations there, but also a lot of the mining happens in China. So there's a lot of miners already there. There's questions swirling around whether you could get a country like China trying to use Bitcoin in a bad actor, nefarious sort of way. Again, I would highlight that as a risk. I think people need to be aware of it. I don't know how big of a risk that actually is, though, because once again, the incentives aren't aligned for that, and it would take so much money and computing power to do anything. It just wouldn't be worth it.
Yeah, and then we had the EU and obviously conservative there. But let's bring it back to China one more time. So because Bitcoin has that reserve currency capability, and we look at China's yuan, and then we look at the US dollar and everything you've laid out for economics. Is there a self-interest for China as it relates to their currency and the interplay with Bitcoin?
Yeah, from China, we've been hearing more about a digital yuan, or just we've been hearing a lot more about CBDC, central bank digital currencies. I fully expect all major central banks to create their own digital currency. But this is not going to be like Bitcoin because it's going to be created by an institution. It's going to be controlled by them. I highly doubt they're going to have any interest in creating a hard cap like Bitcoin because they want to be able to control the money supply. And quite frankly, I think they want to be able to see where the money is. You know, central bankers hate cash because cash can be stuffed under a mattress, cash can be used for illegal things, or quite frankly, they just want to push people to spend more money. They're talking about negative interest rates, imposing them. Well, if you force everyone to use a central bank digital currency, it's very easy to start pushing things like negative interest rates because you can't withdraw it out of that system. So I don't see central bank digital currencies replacing Bitcoin. If anything, they might help accelerate it because now at least you're moving between these different currencies all in the digital realm, if that makes sense.
So we're almost out of time, but I want to finish with this question, Chris, which is related to alternative investments, non-correlated. And there was a really great slide here, you know, with Sharpe ratios, et cetera. But what about volatility? You know, volatility for Bitcoin today, and what should investors be thinking about here?
Yeah, excellent question. It's one of the biggest hangups when looking at Bitcoin from an investment perspective. It's just so volatile, and there's no getting around that. It's true. The proponents of Bitcoin would have a few counters to that and saying, well, if you want Bitcoin to become a store of value and potentially kind of a reserve asset, and it's not launched from any kind of company or government, but it's an organic thing coming out of the market that's bootstrapping itself. Well, what do you expect? Of course, it's going to be volatile. Its market cap is so tiny compared to the amount of US dollars out there. It's going to swing widely. It's also the Wild West. There's no regulator. There's no open hours. There's no market circuit breakers. This thing trades constantly on thousands of different exchanges. So yeah, it's the Wild West. They also point out, though, that you're compensated for the volatility, you're compensated for the risk. And as Bitcoin becomes a potential store of value, we should see the volatility decline, which we have been seeing. And in fact, on many metrics, Bitcoin is less volatile than many S&P 500 stocks. So if you're going to say Bitcoin is too volatile for your portfolio, well, then you better not have any S&P 500 stocks in there as well.
Great. If we can move to the next slide, please.
Let's see here.
Well, first of all, I want to thank everyone for joining us today from their busy schedules, and I hope you found this to be of help in understanding Bitcoin. Chris, you did a fabulous job trying to break down, simplify, and directionally explain everything that's going on with this very interesting nascent trend in Bitcoin. It also opens up the opportunities, I think, for us at some point to revisit Bitcoin at a future CFRA webinar. In the interim, as you can see here, Chris has published an investor's guide to Bitcoin, and you can download that copy as you see on the lower left here. Similarly, we have Market Scope Advisor for subscribers, where you can get more on Chris's view about Bitcoin and, of course, his industry coverage and consumer finance, etc. And we're always interested in having those interested in getting more about CFRA research. You can certainly visit or reach out, and we will be able to help you. As I always say on these webinars, want to make sure everyone stays safe and healthy. We hope this was a useful webinar, and thank you for your time.